Fed chairman raised rates by 75 basis points yesterday, and he made specific comments about the real estate and mortgage markets next. Welcome everyone to Real Estate Daily. My name is Troy, and every day I'm going to give you the best news, best 5 minutes of news in real estate, housing, and the mortgage market. Now, before we jump in, we're going to grow this channel. Hit that subscribe button. Boom, boom, boom. Now, let's jump right into it. Now, I know a lot of you yesterday, some of you were busy or out there, you've heard about the 75 basis points, but what did he really say about the housing market? Because if you really look at what's happening by these raising in rates, isn't really affecting a whole lot. Is it really bringing down the price of gas? No. Is it really hurting the job market and sending jobs home and people unemployed? No. That was the intended use of this. What's really happening? I did go over this yesterday, and now he's pressing the point today. What did I say yesterday? Well, let me refresh everyone. I said the collateral damage immediately that happens with raising rates is twofold. One, it's the housing market and the mortgage rates. And number two, it's consumer credit, meaning consumer debt. Let's say credit cards or small loans or any of that, it goes up and up and up because it's based on the Fed rates and how much they raise. So let's go read what it says here. This is from Bankrate. It says housing market needs to get back in balance, Fed Powell says. Well, let's go read some of the things that he says here. I'm going to go and we're going to hit this paragraph right here because he really hits home. He says housing is significantly affected by these higher rates, which we've been talking about, which are really back to where they were before the global financial crisis. Powell said during the news conference, the housing market was very overheated for a couple of years after the pandemic as demand decreased and rates were low. Let me read that line again. The housing market was very overheated for a couple of years after the pandemic. Why was it overheated a couple of years after the pandemic? Next line. As demand increased and rates were low. Why would demand increase? Because people couldn't afford it. Why could they afford it? And they couldn't afford it prior because he lowered rates to zero. Then last year, what did he say in 2021? That as he received, the new administration received the government, they were at 1.2 CPI. So the inflation was only 1.2. As they continue to spend and as Powell continued to print money, what happened? And the inflation rate kept going up and up and up. Well, what did the government say and what did Powell say? It's transitory. It's going to come and go, But what did he ultimately do? He crushed the economy by poor decisions. Janet Yellen, the worst, right? The worst. She shouldn't even be in the position she's in. More people have made fun of her. She has cost more American families money, her and Powell, than anybody else. They just don't know what they're doing, and it continues to shine. So what do? If we would have raised rates last year, it would have slowed the housing market down. You wouldn't have seen values go up 20% year over year. This is very, very obvious. If you would have went back 20 years ago, right after 9/11, this is exactly what Greenspan did. He lowered rates to zero. And what did he start? He started the housing market, and the housing market went right through the roof for the next 4 or 5 years, making lenders feel like it's never going to end. And so they made radical loans, really bad loans, and that's what came crashing down 6 or 7 years later. Well, didn't we learn from that lesson? Didn't this guy go to college? Didn't he take Econ 101? Didn't he see the last time when rates were at zero, what the effect was going to happen? He absolutely did. Is this a government coordinated plan to really hurt us? I don't know. I mean, it looks like it's just bad business to me when you're saying the things you're saying. So let's go on to the last line he says. The market needs to get back into balance between supply and demand. It would have if you would have raised rates last year. If you would have done your job, if Janet Yellen and President Biden would have said it's transitory, Are you kidding me? You can't be spending money. None of us can go spend and have an unlimited credit card. I'm going to keep spending and spending and spending, and I'm going to allow somewhere down the road for someone else to deal with it. Well, guess who's dealing with it now? It's us, the American public, and they crushed the housing market. We're going to continue to see it. Powell said also in this speech afterwards that he didn't see rates going, he didn't see pivoting anytime soon, probably somewhere in the second or third quarter of 2023. But he saw maybe it wouldn't be 75 basis points, maybe he would go down to 50 basis points. Either way, we're at 4% right now. The CPI is at 8.3. Paul Volcker back in the 70s had made it a point to tell everyone he needed interest rates. He needed the CPI, he needed interest rates over the CPI number. Right? So if that's a fact, we need to have interest rates in the 8s and 9s, right? To be over inflation, the CPI number, for us to start seeing a turn in the market. There's no turn in this market. We have not stopped purchasing as citizens of the United States. We keep buying. We keep buying into stock market. We keep buying crypto. I mean, come on. Isn't it obvious that this is all going to become crashing down all at once? It's just going to be a stock market nightmare coming up here in the next 6 months. It's going to be bring your daughter to the slaughter, right? I don't understand what they're thinking, but they just do not have this right. And it's just a bad policy by a very inexperienced government that we just got a year and a half ago, and someone that just completely ignored two of the biggest recessions in the United States, ignored what experiences that he could have learned from them. We are heading toward the worst recession we've ever had. That's just my opinion. Let's go on to the next. Blackstone's $70 billion real estate fund for retail investors is losing steam. Well, yeah, it's a risk-on asset, number one, but it's not as risky owning real estate, but people are seeing that real estate's going down. So instead of, continually putting into this investment vehicle, they're just pulling it out. And what are they doing? Well, two things. One, I can make more money in the stock market. That's number one. Number two, I'd rather put it, other people are putting it in bonds where it's secure, it's backed by the United States government, and I'm going to get a return of 4 or 5%, right? And so that's what people are doing right now. They're not investing so much in real estate. But let's be very honest what's happening. First of all, what is Blackstone versus BlackRock? Let me just give you a little bit of history lesson here. Larry Fink used to work for Blackstone. He had a difference of opinion with their board. So he spun off BlackRock. He spun off himself and started BlackRock. And Blackstone has gone more towards real estate and other investments. So they're two completely different entities. Now, BlackRock, has a lot of, people's retirement funds. 401ks are all kind of tied into it. Sovereign wealth funds are all tied into BlackRock. Blackstone is a little different. They're more conservative. They're not as, government intense. So, but we're just seeing that things are changing here. Now, but let's go look at what a few things that they're doing. It says, this is Blackstone. It says it swallowed up apartments, suburban homes, dorms, data centers, hotels, shopping centers. It owns the Las Vegas lavish Bellagio Hotel, a 76-story New York skyscraper designed by Frank Gray. Look at what they're owning. They're trying to take over. They're trying to take over the piece of pie that a lot of Americans need. And the more they buy, and the more that it's harder to get a loan, the more they're going to suck up, because they're buying cash. They're not buying credit. They're buying cash. They're not buying mortgage rates. They're buying cash. And they're buying people's cash, their retirement funds. They're taking your retirement funds and using it against you. You just don't know it. One day, I hope you'll roll out of bed and figure it out. They're in bed, as we know, with the SEC. And if you're on our other channels, what do you call him?
Crook. Egg boy is a crook.
Egg boy, Gary Gensler, is a crook. All right, let's jump to the last one here. It's the rates. Now, the rates didn't really move that much except for jumbo. Jumbo exploded, guys. Jumbo exploded. Why? Because a lot of people are using jumbo loans. So 30-year conforming conventional was flat. FHA was up 3 basis points, but look at the jumbo, conventional jumbo, 20 basis points. It's about ready to roll over 7%. Wow, this is stalling the market out. We're going to see this. We need to see something happen here. We need to see the Fed. They can continue to raise rates, but if you're going to crush the housing market, the only way to get out of this is not only raise rates, but to buy mortgage-backed securities and get the bond market down. Will the Fed do the right thing? You keep raising rates, you keep killing people's debt. That's all you're doing is crushing the consumer debt and the housing market. If you were to come in and buy the bonds back and buy mortgage-backed securities, bringing bonds down, you will then continue to go after inflation, which people are looking at inflation as gas or food, utilities, insurances, but you'll bring down and at least level out the real estate market. And that's what I'm calling for, is to bring in and buy not all mortgage-backed securities, buy a percentage of them so we can start seeing rates come down a little bit and have an even playing field between buyers and sellers. Guys, thank you very much for joining us today. Again, leave a comment below if you have any questions. Otherwise, hit that like button. If you like the content, I'm here to give you the best 5 to 10 minutes in real estate every single day. Otherwise, guys, you take care and I'll see you tomorrow.